Biotech stocks can be life-altering. They can be life-altering for the people that take the drugs that they develop. They can be life-altering for people who trade options on them. We're going to talk a little bit about that today on Open Interest. We can start by sharing my screen, I suppose, and maybe if I leave it like that, you won't actually be able to see it. So I'm just going to look at this. Here's the chart from, I don't know, let's go back to January of 2025. Why not? And there we have it. Okay, so that is the chart of Moderna. And inclusive of today's move. Let's throw that in there for good measure. Up 177% today. What's going on? A personalized vaccine that was developed by Moderna and Merck also, which was also up sharply today, which probably we'll look at that in a second as well, apparently reduced the recurrence of melanoma in large late-stage trial, and that is raising expectations for treatments of the deadliest form of skin cancer. And this trial met its main objective for the vaccine and combined with Merck's immune drug Keytruda, which sounds familiar to me for some other reasons, but we can probably look into that. That prevented the cancer's return after it was surgically removed, more often than with immunotherapy alone. Now, we have a decent-sized position in Moderna via one of our options income overlay strategies, MRNA. That is MRNY. In this strategy, which I'm going to show you now, we sell covered calls. But we don't just sell covered calls. We own the underlying stock, and then we will buy an upside call against the short call. The logic on that is that in so doing, if something idiosyncratic takes place, so, if the stock just goes sideways or it goes lower, we're going to collect a little bit of premium. But if the stock does something really unusual, we won't be utterly crushed that we missed the move. In this particular instance, 3,700 of these things, and it's interesting here because they clearly must have adjusted some of these positions. But the difference in the strikes that we have positions on are the 65s and the 70s. So $5 difference in those strikes. So consequently, today, when the stock was up, our Moderna positions were able to participate. Not completely, but they did participate fairly meaningfully. So, in that particular strategy, and you can see it's still ticking here, but about 176%-ish, we'll call it, which is not bad when you consider how much we had in the stock to begin with, which was about $116 million. So, give or take, we made about $200 million today in MRNA. How were we able to do that? The reason was because we were selling call spreads rather than simply selling covered calls. So that's kind of an important reminder or a lesson about what can happen when I show this chart, which is the historical return histogram. What happens when you get these moves that just simply don't factor very well in options pricing, right? So if we look at Moderna's share price yesterday, which was, where did it close? $62. So we were short the 65.70 call spread. forgive me 1 second. That might be somebody calling me about that exact situation. In fact, and it's a little bit urgent. You can understand we're professionals here, so you're going to give me 1 second. I apologize. Hey, I am on a live stream, yeah?
Okay. Send me a quote ASAP. I need an article on this sort of
Okay.
interesting, suspicious volume.
I will take a look at that, and I will cover it.
Can you get us?
Well, I'm on, like I say, I'm on a live stream, so there are people watching me on the phone with you as we speak. So I'm going to hang up now. Bye.
All right, great.
Sorry about that. It is the unfortunate reality that sometimes work must intrude. So I do actually have to take a look at another position, which maybe we can do that together. In fact, maybe we will do that together right now before we get back to this. But the quick point is that if you were short a 65.70 call spread on a stock that is trading for 62 bucks and change that expires at the end of the week, even if that call spread is all but worthless and you don't cover it, which you probably should, but even if you didn't, right? So just to put things in perspective, you may remember that on many occasions I have suggested that if you're going to be short options on equities, then you want to be earning an equity-like return. What's an equity-like return? It's going to vary from one stock to another. Depends on how volatile that stock is. But in this particular example, it's a fairly volatile stock. You know, I would hope to be making probably 20% plus if I was collecting premium in a name like this. So 20%, you figure, well, let's make it a little easier mathematically. Let's call it 25% in a week. That's going to work out to 50 basis points of the current stock price. The stock was $62. So effectively, we would have needed to have had 50 basis points of the stock price in that trade, essentially to continue to carry it through the end of the week. We did carry it. We're generally going to be short premium. But the important part is that in that instance, so you sacrifice the distance between the strikes, $5 over the $62.50 that the stock price was, less whatever premium you had collected to initiate the trade to begin with. Effectively, you're making every dollar in the stock above $70 for dollar, which in this case is $104 per share. Every options contract representing 100 shares, that's $10,400 per spread. So I just wanted that to sort of serve as an important reminder. There's something else I thought might be kind of interesting that we could look at here, and that is that this is a stock that was particularly vulnerable for this kind of a move, and we don't talk about it that often, but we have brought it up once or twice before. And that is that it had a fairly substantial short interest, 13.5% of the float. Both S&P and S3, which is a market data and analytics provider over here, they provide statistics which indicate how likely they think a short squeeze is, or how at risk a stock is for a short squeeze. Now, in this case, we can take a look, and S&P's score, which I believe only goes from 1 to 3, was already right up there. And S3's, this one, I'm trying to remember what the ranges are, but 50% is, whoops, where is this? Short interest on the, oh, well, these sneaky buggers. I'm forever getting cut back on what, so normally I was able to just drill into that and get additional information. I'm sure it's available online. All I'm really getting to is the fact that the elevated short interest in Moderna made it more vulnerable to this kind of a move than stocks might otherwise be, because that was, and it's being reported that the short interest here was probably like a $5 billion loser. Now, I will point out very quickly that short interest that is related to options positions isn't necessarily going to be a loser in that way. Why is that? If I'm an options market maker, somebody's selling upside calls, as we did, by the way. So we sold upside calls, but we sold call spreads. That's going to end, whoever took the other side of that is going to end up long deltas. So they would sell maybe some stock against that to maintain some form of delta neutrality. and all of a sudden, the stock takes off, and they lose some money on the short, but they might make some money on the long calls. Now, this is an interesting. Oh, good. So we have the ranges here. Our helpful crack production staff on the East Coast. So let's get, so if you're looking at the S3, so low short interest, 0 to 5%, minimal bearish sentiment, short interest positions are low and unlikely to impact stock price behavior. Moderate positioning, which is going to be in the 5 to 15 range, noticeable short exposure but not overly crowded. Price action is primarily driven by fundamentals or broader market trend, macro trends. Crowded shorts, 15 to 30% plus. High bearish positioning, where a significant portion of the float is shorted, elevating the risk of high volatility and potential short squeezes. So many of you will probably know that Roaring Kitty, whatever the nickname was, but we're talking now, of course, about GameStop and subsequently AMC, that this was something that they would screen for. They would look for companies that had high short interest and then, look for and maybe even try to actively promote a squeeze. This is not a strategy I recommend. In my case, as a regulated person, it's not a strategy I either can condone, encourage, or engage in. But it is worth noting for traders and investors that you should probably be giving some thought to the short interest. The other thing I would say is, and this serves as a reminder, and I've brought this up before as well, that where biotechs are concerned, I have rarely played that game because in those situations, I have seen these kinds of moves. So here is another name that apparently had an unusual move today, and this is actually what I was just being called about so urgently on the line that I had to interrupt this. And the question I was being asked was about unusual options activity. There was quite a lot of activity today, as you can see here, 123,000 calls trading, but the stock is already up. But one other thing we can see is that there was definitely unusual volume in this one yesterday. In fact, there's quite a lot of volume. Go back, let's see here. Interesting. So, the question being asked was there anything particularly suspicious that was going on the option side ahead of all of this? And to do that, why don't we just we'll go back in time. Let's go back to Monday. And then let's take a look at this and see what we can see. All right, so any more pages of this, or is that pretty much it? And when did that move take place? I actually have to see because I didn't actually catch what was going on here today. Oh, there we are. Okay, so the big move took place at 10 past 3. And all of this activity over here was going on before all of that. Interesting. Okay. So this is something else. We're having kind of an interesting day today as we kind of work through unusual circumstances and how traders might think about interpreting them. And one of the things what we are seeing here is that there was quite a lot of activity before whatever this news was came out. So let me do this. I'm going to just screen grab that because my colleague needs this rather urgently. And I'm going to pass that on to them. This is one of the, and again, I apologize. As you guys know, usually I try to focus as much. I'll usually have something that we plan to talk about in general and then get to it. But today was kind of a busy day because I also had a presentation for Red Chip, which I think is going to show up on YouTube as well, earlier this morning, and a fairly busy trading day. And then we had a bunch of unusual news. News at, that was 3:10 p.m., right? I'll just, okay. So let's figure out what was going on here. Hyperliquid strategies up, exchanges down on Trump comments. What were his comments that I obviously missed? So hyperliquid strategy shares rose as much as 30%, the most on record after U.S. President Donald Trump said that the CFTC chair, Michael Selig, is working to bring hyperliquid to the U.S. I understand that Mike is also working to bring hyperliquid into the United States in a fully compliant and legal fashion, working very hard on that, he said at a White House event. So, in this particular case, I'm not exactly sure what somebody might have done with this. That news came out and the stock popped. The only thing one can do, I suppose, is monitor unusual activity. So, for those of you who have, let's actually do this. I'm gonna see if that just started to pop up over here. It probably did. Let's do. Where is that one located, by the way? I don't think that's officially here. So let's get rid of this. I guess there was a lot of names with unusual activity. Anyway, so for those of you who are using unusual whales or something like that, you have that to keep an eye on. And my crack producer is giving me something else. What was that? Just so I can get an update. Oh, Oliver Rennick cited it. Okay, good. Well, good for Oliver. I'm glad he brought that up. I'm curious, Monday morning quarterback. So one other thing that's going on here, I think I referred to this on Monday, is that this whole machine has been wiped and started over. So I don't actually have the social media feed in here again because all of those things were saved in some prior configurations. I don't have them, but I'm going to get that in just a moment so I can pull that up and keep track of your questions as well. But Oliver Rennick, I like Oliver. I think he's doing good work, and it's actually one of his colleagues that was just reaching out to me also on the side here about this. I'm actually rather surprised because he's on the SIBO, so he should have access to this information as much as anybody. But we have seen this before. One of the interesting things about options is that unlike equity volumes can rise and fall, and they can rise at a time when you don't expect it, and you should pay attention to that. We care about unusual price action. We care about unusual volume because it can indicate that there's something more going on than we might be aware of. It's what actually can get us looking at something in the first place. This one would not have appeared and did not appear on my radar because it is not a name that's in my universe. It is not a name in our portfolio. It's probably not even large enough to be considered for it. I'm going to double check and take a look at the market capitalization. Maybe it is. Let's see how big it is. Market cap, no, it's not. 1.8 billion. So we would not normally be looking at a name that size. But that doesn't mean that you should not be. And, the principal reason that we're not doing it is simply because it may not have sufficient liquidity. And I think it's actually in our pro that we don't, deal in anything that I don't know what the bottom side is. It might be 10 billion or a little bit more. But typically we traffic in large cap stocks. So this would not have qualified on that score. But it does emphasize the importance of monitoring unusual activity. And I'm actually kind of curious, and it was one of the things I'd originally intended to do, was to see whether there was any unusual options activity in Moderna before today on the call side. Because, and I probably did this just to torture myself, so why not? Just out of curiosity, I was thinking, did the August 75 calls, those are the calls that expire at the end of this week, did they happen to trade yesterday? And if so, what did they trade for? And but without looking, I ask each of you to guess for yourself what the turn on those calls was if they did. In other words, what percent did they make overnight if somebody had traded them? And the answer is, if you don't know or can't guess, it's 168,000%, I think. Those things traded for a nickel yesterday. And obviously they're worth considerably more than that. They're not in huge size, right? But you can imagine if somebody had, I don't know, bought a 10 lot or a 100 lot. A 100 lot would have cost you $5. $5 per contract, $500 in total. And those contracts are worth $8,400 plus today. So that would have been quite a nice return, I think we can safely say. Anyway, I thought that was kind of interesting. So let me just try to grab the social media link here, and maybe I can even get a little bit of help from the production staff on that, and they can post a link into my channel here so I can pull that up. I obviously, again, apologize. I have a lot of things I need to get configured over here to get back to normal. So hang on one second, and we can get to your questions. Let's see. Actually, one other thing we can do while I wait for that is we can take a look at what else was really moving today, because this is something that we generally do for one of the other funds that I'm involved in. This is the one that Carter Worth manages, the Worth ETF. Moderna would not show up on his radar. It would not show up on his radar because he does not traffic in biotech either. So let's see here. But we have a couple other names that have moved fairly considerably. Estee Lauder. Well, that's an interesting one. Let's see what's going on there. So, see what the news was and figure out whether there might be something to do. Soars on, let's see. Aha, there we go. All right, so now I have your comments. Hopefully that just popped up. Let's see if it did or not. It did. FinWest, hi. Good morning, sir. How are you? Good afternoon for me, but good morning for you. Steve Garcia, good afternoon to you. What do you think of the U.S. Treasury doubling its buyback of long-dated bonds? Little deal or big deal? Is gold going to rally because of this? So, a couple things about it. In general, I think it's a bigger deal in terms of what it signals than its actual size. So there have been several events that policymakers have made, including the twist that was done a number of years ago. That was, I think, during the Bernanke era. So we've had a couple different things that have gone on. But to me, what is more interesting is just the simple idea that they're going to try to play a few games, as you would expect them to try to control rates. The president wants lower rates. Warsh wants lower inflation, or at least he always has, and he hasn't liked monetizing debt. He hasn't liked inflationary policies historically. And so when you think about what Bessent might do, he is a part of the administration. Whatever they can do to manipulate the curve in a way that the administration favors. Number one, I guess we shouldn't be that surprised by it. Number two, from a fiscal point of view, the government is kind of painted in a bit of a corner, right? $40 trillion in debt outstanding. Of course, the real government liabilities are substantially larger when we factor in unfunded liabilities, including things like entitlements and so on. Those numbers are substantially larger than that. So, the amount of room or latitude that the government has to accommodate the financing costs, the interest expense of significantly higher rates is really limited. So the short version is yes, I do expect that to be bullish for gold. In fact, I have said on a couple of occasions relatively recently that I was bullish gold, and actually wrote an article, and I think we talked about the trade on GDX recently, and in also Newmont. I think I wrote an article on Newmont. I'm going to say it was about a week ago, maybe 10 days ago, something like that. We can look into it. The point that I was making, and I'm pretty sure I highlighted it on open mic, but this was what I was looking at. So I was looking at this being a chart versus the long-term moving average for gold. Then I pulled up this chart, and if any of you guys were watching it, you'll probably remember it. This is the gold miners, and I pointed out that the gold miners were just to but not yet through, so obviously it had to have been back here. So maybe it was more than 10 days ago. When was that? Because I was pointing it out on this rally here. We were not yet through the long-term moving average. I made the same point about the junior miners, that they had gotten to but not through, as you can see here. But on that day, Newmont, which is the largest constituent of the miners, had indeed broken through. And I used that as my tell that the others were going to follow. That was kind of our leading indicator. Perhaps some of you will remember this conversation we had. So today is the 19th, and that would have been back on the 6th. So yeah, it was almost, actually it was 2 weeks ago, I guess, that we had this conversation. So, yes, I think this is bullish for gold. I would stay long the miners. I would stay long the junior miners. I would stay long the metal. Obviously, Newmont's had quite a move already. Maybe it bumps into a little bit of resistance if it gets back to here, because this is a level that corresponded with much higher gold prices. So, one could argue, I might argue, that even though I was, making the bullish case for Newmont, that now it having moved farther and faster than the rest of the miners have, and faster than the metal has, and faster than the junior miners, which actually often have more beta, that I might actually just simply deploy to the metal. But yes, I do think that is bullish for gold. Okay, so let's take a quick peek now while we're at this. Upcoming events, because there is not much left. Actually, no, let's do this first. We're going to do a little earnings analysis. So we're going to take a look at this earnings season, and then we're going to take a look at what remains. And as you know, the way they set this up, I'm not particularly crazy about it. I usually think of the beginning of any given season as the period when Delta and the financials announce. But during this period, and this is actually the Russell 3000, so this is basically, even beyond all of the names that I would normally trade in, because we're Russell 1000 only pretty much. But virtually everything has reported. And so far, so good. So we can see that in general, we've gotten better than expected sales. We've gotten better than expected earnings. But the more important point to me really is to look at these results in sort of the context of how are companies really doing? In other words, if you set the bar exceptionally low and they beat those very low bars, is that important? Or how are we doing in general? And this is kind of the number or set of numbers, I would say, that I think is kind of most impressive. Now, granted, we have a relative handful of companies that are really printing money, and that's going to drag all of these numbers higher. But in general, these are really quite positive numbers. I would go so far as to say that I think that this summer has turned out to be, the period in between Memorial Day and Labor Day. There was an old saw in trading, sell in May and go away. I actually had kind of felt like there was some risk. We had seen that the best performing stocks, hardware and technology, they seem to have had a great move, but were kind of slowing down a bit. Obviously, software and services had largely been slammed. And then we had a lot of old economy stocks that had had huge runs. That was illustrated in another basket of stocks that I've spoken about more than once, which is the Dow Jones U.S. 100 Dividend Index, and how much it had outperformed the S&P, which kind of reflected that rotation. But I think what we're seeing now is that there was something to back that up at a high level, which is of course going to be a positive. And actually, I think this question right here is kind of related to this. Hi, Mike. Do you trade around seasonality at all, or just leave it alone? Well, there is one thing from a seasonality standpoint that I do tend to pay attention to, and this is just more from a volatility trader's perspective. One of the reasons this is going to be true is that, understand that for the most part, we do have short positions. We have a handful of short funds. But by and large, we're long stocks, right? And one of the other things I would quickly add is that in many cases, we have only a relatively limited amount of flexibility with respect to those positions. So, for example, our largest position across all of our funds, and it's in several of them for all of the reasons you would expect, is NVIDIA, right? And it's one of the largest companies, so therefore it's going to be in funds that are large cap. It is, we have a couple of funds that focus on chips, semiconductors. So of course it's going to be in both of those. And we don't say, oh, well, September is a more volatile month historically on average than other months are, which it is, by the way. So therefore, we're going to reduce our position in NVIDIA. We can't really do that. It would have tax implications. There's liquidity constraints because I don't know exactly what the NVIDIA positions are up to right now. It's probably 1.75 billion or so in NVIDIA across the various portfolios. But you obviously can't just blow out of that because you think Labor Day is coming, and after Labor Day things get choppier. But that does not mean that I don't think about it, and it's certainly something that this is a place where self-directed investors have a material advantage. And that material advantage is that, if you don't have $1.5 billion, $1.75 billion worth of stock to sell, and also you have that discretion, right? So if you're managing money on behalf of others, you may have a general opinion about things, but what you are doing, if you pull NVIDIA out of your portfolios, you're making a very specific call that it is going to underperform. So, again, that kind of limits what the professional can and is likely to do. The combination of liquidity, tax, just making essentially a directional bet, which is what that would be on a short term, not really what most professional investors are called on to do. But one of the things I have done is that when I have seen the term structure quite flat in the S&P, which we can take a look at here, is I've gotten long calendars. So there was a couple of years ago, this got really, really flat. And what I observed was that, I'm going to get rid of this so we can just look at one curve here to kind of make the point. What I had observed was that options that expired before Labor Day, and Labor Day, when is Labor Day? I should know this already, but what exact day is that? So I could probably figure that out, of course, right? So I can tell you this much. We know it's on the 7th. Okay, so this is 31st, 2nd, 4th. When is that? That's the 8th. Okay, that's interesting. That's the first day after. So right here, September 11th. Not a happy day to remember. One of the things I had noticed a couple years ago was that the handful of expirations immediately following Labor Day, so that first Friday, and I guess that would be true here, was about the same or even slightly lower due to some short-term volatility event than straddles and strangles that expired just before. And we know that September is typically a higher volatility month. October too, but September is probably the one that most people would think of. Things like Black Monday and a couple other really catastrophic events for equities have taken place in October. So I think that's kind of ingrained in people's minds that that's when the real volatility market crashes take place then. But September is typically a choppier month. And so I have definitely found situations where I've said, you know what, I'm going to get long Sep and October volatility and short this and short that. So long here and short these, sort of creating a calendar fly of sorts. The idea being that around the holidays, sometimes volatility can come in a little bit. Plus, you also have shortened trading sessions, right? Because in November, we have Thursday off for Thanksgiving. It's a half day thereafter. We always get at least one day off for the Christmas holiday in December. So if you're using month end or if you're using January to go out on the long end, you're going to get, depending on what day it falls, you might get a half day, a day off, and then another day off for New Year's. So if I'm using January. So I have definitely done that from a seasonal standpoint when I have said, that's a seasonal trade and for, no other reason. So fewer trading days during the holidays, that's a seasonal thing. Higher volatility in September and October historically, that's a seasonal thing. And that I have certainly done, right? So it's something to consider. Right now, it doesn't seem like it's completely out of whack. This curve right here, the term structure, seems to make some sense to me. Remember too, and this is probably important, this came up actually when I was giving the presentation earlier today. I was asked a question about dispersion. And dispersion, as you guys know, because I've talked about it on more than one occasion, the relationship between single stock options prices and index options prices. And I tend to talk about this in a very sort of hand-wavy 30,000 foot kind of thing. It is important to remember that this relationship is a path-dependent one, right? So what I mean by that is that if all I did was take the implied volatility of a stock and an index at the money and just make that my overarching assumption for implied volatility in that underlying asset for that tenor, for that expiration, for that many days to expiration. That's a little bit misleading because you can get into a situation where the skew, how much the puts implied volatility is relative to the at the money and the calls are at the money, might be indeed very, very different. And, that is, in fact, the case. One CNBC talking head today essentially said he's ducking out of the equity markets for the third quarter, hence the question. Oh, okay. A talking head said he's ducking out of the equity market. How's he going to do that? I'm curious who the talking head was, and is he an institutional investor? That's something else I would add, by the way, is that most investors who hand their money to other professional investors don't pay them to sit in cash because they could sit in cash on their own just fine. So it's kind of another important point, right? the funds we run are fully transparent, which means that you guys can all see exactly what our positions are every day, right? Because they get updated overnight. You can look and if I was managing money for you guys and I put it all into cash because I said it's being risky. You might say, you know what? I'll pay the guys over there 1% a year because I trust their acumen, and I trust their timing, and I trust their judgment. And if they don't think now's a good time, I'm going to let them essentially keep the interest that they're going to be earning on my assets, and then I can go and do whatever it is I want to do. But there are a lot of investors who would not go along with that and say, if you're going to put the money in cash, then I don't need to pay the 1% for that. I can just keep the money myself and do it. So I am curious who the talking head was that said that they were just going to duck out of the equity market. Also, sometimes from a practical standpoint, that's not that easy to do. Some of our funds are pretty good size, but there are some funds that are huge, right? You have 10, 20, $50 billion in equities, so you can't just blow out of it. Poorly phrased, he was going risk off and awaiting the expected seasonality effect plus valuations plus macro plus midterms plus Fed. Yeah, and that's right, by the way. So, you also have the midterms, and that could certainly create a little bit of volatility as well. The midterms are not an every year seasonal type of thing, but it is a seasonal thing, right? So we get the midterms, midterm, right? So presidential election every 4 years. We get a midterm election every 2 in there. So there's going to be one or the other. That can certainly contribute some volatility as well. We saw that actually back in 2016, much to a lot of people's surprise, and maybe a bit to mine too. We saw some real movement when it became clear that Trump was going to win when he was running against Hillary Clinton. And we had the futures basically whip to the limits in both directions. I think they went limit down and then closed, then ran limit up. I'm sure we could probably look that up if we wanted to, but it was quite pronounced. I do believe that we are in a relatively quiet period right now. The VIX reflects this. I don't expect this to persist through the end of the year. I would be, frankly, pretty astonished if we didn't get a meaningful uptick in volatility. So let's just go right to the end of the year here and compare where we are right now. And I'll draw a line here, right? So this is the forecast, which is quite low. And I would say that if you were going to be long or short volatility at a high level on the index side, which would be a very handy way, by the way, to mute your volatility. Because if you went and bought straddles, hedged them dynamically, or bought strangles, which is how I would normally do it, by 20 to 30 delta puts, 20 to 30 delta calls, and hedge them. And, that way I'm not paying away huge amounts of decay. If we get a big price jump, I'm likely to win on that. If we get an uptick in volatility generally, I'm likely to win on that. If we get into a low volatility environment, realizing, call it 9%, which would not be that unusual, right, in a relatively calm market condition. Really low realized volatility like we saw in 2017. I don't even think of that as being on the radar. So the amount I would really be risking would be on the hedge component, which would be the index piece, as reflected here, is relatively low. So if that's the kind of thing you're thinking about, I think that makes sense. Another way to handle that would be to just use something like put spread collars on the index, right? So against your long equity book. Is that a perfect hedge? No. Does it give you some upside? Yes. Does it give you some measure of downside protection? Sure. And actually, here's another way to think about it, right? So if you put on a put spread collar in the S&P and the market has a correction, draws down 10%, and you had a 5%, 5% put spread plus a short call to help finance it, well, that's going to offset about half of a correction's decline. And are you in your long equity book willing to tolerate a 5% drawdown? I would imagine that you are, because how could you be invested in equities if you couldn't tolerate a 5% drawdown? I mean, that's commonplace enough. It shouldn't be the kind of thing that should scare one out. So I think that would make perfect sense, in my view. And that is the way that I think you're not going completely risk off, but you're reducing your exposure, right? Buying something like a put spread collar on SPY would do that. Let's illustrate it just for purposes. We can talk about things, we can show them. Better to show. Show and tell time. So, and we do have protective puts in some of our strategies as well. The more absolute return focused Alt-E, for example, we own downside puts in that. Those positions are kind of collared. Still looking for a tailwind, but net positive carry, but have some protective puts as well. Okay, so here's an equity position, right? You could modify this. Let's just assume this is your exposure, right? That's well, let's bump this up. Let's do this. Let's make this 180 shares. That probably gets us to something pretty close, right? Actually, you know what? 200. I only want to do this so we have nice round number. Okay, 200. So you got it. Whatever. You've got something in the neighborhood, give or take, of $150,000 that you want to protect. How do you do that? You can go out in time. You can trade a couple of puts because we're going to buy one, sell another, and trade a call against it. This is going to be net short options. So whenever you're net short options, you want your time to expiration to be approximately comparable to what it would be if you were just doing any other kind of a short options trade, right? So I'm going to go out 58 days. It could even be slightly less. You might say, okay, 44 days, something like that. Maybe not a bad idea. In terms of the options that you're going to sell, the strikes that you're going to select, what are the common deltas that we might look at for something like this? Well, we could go ahead and say, okay, well, I'm going to sell somewhere between a 20 and a 30 delta option. Let's just make it 20. I mean, the 800s are, that's probably not a lot of deltas there, but I'm going to use it because it's a nice round number. Why not? And then I'm going to find something over here that we would sell on the put side. And let's see what we get this to. So 20 delta. There you go. So this costs a little bit of money. I need to do 2 of these, by the way. And you end up with a position that looks like this. So you're going to mute your downside a little bit, as you can see here, because that goes basically, that's the 5% that I was talking about. You still have some upside. Not quite 5% to the upside. And this is 45 days, by the way, which is not, it's not like you're putting a set and forget lock on your equity book for a year. I mean, we're talking about, muting the downside damage to the tune of a little less than 5% over the course of 45 days, 6 weeks or so, because you wouldn't be able to do this until tomorrow or Friday in any case, and still giving yourself some upside participation. And in the event that it draws down to, SPY goes back down to 700, which is nearly correction territory, call it 680, something like that, formerly correction territory. You have a 770, 738 put spread on. So you're going to have taken about $32 of the pain out of that downside move. And still you get some upside participation. So this is a way that you can, and this one has a standstill cost, but it's not huge, right? And this is a way that you can reduce your exposure, kind of kind of the way that maybe the talking head. And again, I'm curious. Are you going to tell me who this was? I want to know who the talking head was that said that they wanted to reduce the risk. Since we are talking, let's see if I can guess who would have said something like this. You said it's a pundit, a talking head, which makes me think that the person you're referring to is somebody who's on more often than not. Because I don't really think of, if they get somebody on who's a professional money manager and they're on once a quarter, once every 5 months or something, that's not really a talking head. That's a money manager who happens to be getting interviewed, not really a talking head. So I'm going to assume when you say talking head, you are referring to somebody who's on regularly. Who's on regularly in the middle of the day? It would have to be the middle of the day or somewhere thereabouts, right? Because I'm talking to you right after the close. So maybe around halftime, maybe around Scott Wapner's hour, someone like a Stephen Weiss, Joe Terranova, Jim Lebenthal, maybe one of those guys. Curious. Let me know if I'm in the right ballpark, but that's my guess as to who might have said something like that. It was a guest on closing with Wapner, not a regular. Okay. Well, it was Wapner, so I had at least part of it right. I had the host right. I wonder who was on. Because, well, who often talks to Scott Wapner is Jeffrey Gundlach, founder of Double Line. I'm assuming it's not him, though, because I think he's famous enough, the new Bond King, having taken over for Bill Gross. Let's see who was on today. If I can find out. So who was... I don't know that I have an easy way to tell who today's guests were. I guess I don't. Let's see. Not hugely important. I mean, it where it does get important is that there are some people who I am very curious about their point of view, particularly if they tend to look at the world the same way I do, and there's something that maybe sticks out to them that I hadn't noticed. Right? We all have a certain limited amount of bandwidth that we have. Something you guys were able to clearly see at the beginning of today's live stream because I was a little bit constrained between everything else I've got going on. Hopefully, AI agents are going to make my life a whole lot easier in the future. Yeah, then you probably won't need me anymore anyway. Is it someone from BlackRock? Okay, interesting. I will look into that. I will look into that. Oh, the producer just told me who it was. Who is it? Oh, Rick Reeder. Okay. So for those who are interested and are now curious, Rick Reeder is the name of the person. So he is none other than BlackRock's Chief Investment Officer of Global Fixed Income. Roughly 2.4 trillion, only 2.4 trillion in assets. How on earth do they make ends meet over there with just 2.4 trillion in fixed income assets? One quick point I would make about this, and that is that in the hierarchy of investment professionals and their tendency to be nervous or anxious about potential risk factors, in my experience, credit guys tend to pay close attention, maybe the closest attention, and options guys usually are going to come in kind of a close second. And why is that? Relative to equity folks. And the reason is that oftentimes, if you're an options person, you're selling insurance. You're selling insurance on equities, in this case, is what we're talking about. It doesn't have to be. It could be other, you could be selling premium on other types of instruments. But for our conversations, it's usually going to be equity insurance that we're talking about. So, of course, they're going to be concerned about it in much the same way that an actuary selling insurance on any other product is going to care. And credit guys do, too, because they're always looking for the the cracks and the ice underneath their feet. Because if you own fixed income instruments, the amount that you can potentially make is usually pretty capped, right? That's not to say that if you have a lot of duration and rates go sharply lower that you can't see meaningful capital appreciation. Of course, you could. But for a lot of them that have equity exposure, corporate exposure in fixed income, then they are going to be more concerned about things like credit risk and stuff like that. So, I always do find it really helpful and interesting to listen to folks on the credit side and see what it is that they're getting concerned about. Certainly, when I look at things like credit rating changes, that's one of the first things I used to, for somebody else. There was a family office I used to advise, and they like to sell a lot of covered calls. And I remember, and they had a portfolio with a lot of stocks in it. Call it 60 stocks, and most of them were, blue chip types of names. And I remember distinctly one time that had a position, and there were usually a lot of people sort of on the investment team that would talk about it, talked about the stock. And I remember they had asked me, "Oh, what do you think?" And I was like, "Oh yeah, no, I think the stock is fine. I don't see any reason to sell it." And the next week, there was a fairly pronounced move, and one of the things that we had not been paying close attention to was what was going on the fixed income side. And indeed, there was a credit rating downgrade, and so that credit rating downgrade had in fact been telegraphed in the price of their corporate bonds. In other words, that the spreads had widened even before that had happened, which meant that investors on the in fixed income land had begun to see trouble before people in equities did. That's sort of what happened in the GFC too, right? So the fixed income markets really started to crack in 2007. But most people who are keeping their eye on the stock market, even though the equities had topped out in late 2007, I don't think that many really fully appreciated just how severe the problem was. It was really people on the credit side, partially because they had also helped, build the Jenga house or whatever you want to call it, with all of these crazy derivative products that were pretty deeply flawed. So of course they had a better understanding, but it is worth keeping an eye on that portion of the market from time to time, and just seeing whether you might observe some additional risk there. All right. Well, I have taken up and interrupted and not well prepared for an entire hour of your time. So I always appreciate your time and attention. I do so particularly today because I literally moved straight from trading, getting some reports back from some brokers I was interacting with, wrapping up with a presentation, and still trying to get my machines back to a place where everything works as intuitively as it should. And I'm not quite there yet. So I really appreciate your participation, your comments, your questions, and your tuning in today. And I look forward to talking with you guys again very soon when we do the next one, next Monday after the close. Until then, trade well. Have a great end of your week and weekend. And thanks as always for watching.